Good evening and welcome to Money Matters. My name is Jim Butler with Videre Wealth Management. My co-host tonight is Paul Mitchel in commercial banking. Welcome, Paul.
Jim, a real pleasure to be here.
Good to see you again.
I understand we have a good show this time.
We do. It's very unusual. We have a quite interesting guest to move to. But before we do that, let's talk a little bit about the current business climate, although we don't want to date ourselves in this show, of course. But I think generally being early in 2018, after coming off a fairly strong 2017, certainly the economic indicators, all the way from major market indices to growth indicators, productivity, inflation, are moving in the right direction and would certainly appear to be poised to continue on that growth pattern. Your background is a little different because of spending so much time in banking.
Right, and mostly in the smaller end of smaller end of the companies that banks deal with, small business or the business banking sector, companies up to sales of perhaps 10, 20, 30, $40 million in revenues, as opposed to the large billion-dollar companies that are major players in the stock market and that type of thing.
So what have you seen really over the past 12 months or so, and then how does that translate into, say, 2018 in that marketplace?
Well, what's interesting is there's some spottiness. Not all sectors are doing very well. Some sectors banks are looking at more cautiously. Certainly retail in general, for example, even the large sector, companies having some issues there with the bricks and mortar stores and that type of thing. Also commercial real estate, even the small commercial real estate where people might buy individual properties to rent out or something like that, where you and I might buy a property for a few $100,000 or something like that.
Right.
There's some talk about, well, is the market getting a little saturated? We're getting toward the top of a cycle again, perhaps. Everybody's getting into the market, prices get driven up. There's some head scratching. Generally speaking, though, I'd say in manufacturing and the service area, there's been increased optimism. Banks are very hungry to lend money.
Okay.
They're very hungry to lend money to good, solid, great, strong credit companies.
The cream of the crop, if you will.
If you will. So that leaves still behind, some of the earlier stage, very entrepreneurial companies, perhaps, that aren't that sophisticated, perhaps in their financial reporting. Perhaps some companies that still had some issues 3 or 4 years ago in terms of, is that the kind of trend that a bank should be looking at and relying upon? They want to see, a long trend of good, steady growth, earnings, profitability, that type of thing.
So have you seen a relaxation of some of the regulatory standards to allow for other credits to be considered?
Well, yes and no. I mean, banks, certain banks, especially the smaller banks, are getting more aggressive, I would say. At the same time, some of these regulatory issues, you can't ignore them. But compliance is a big deal.
Sure.
I mean, you read about in the newspapers how the big banks and big companies have just been slammed with hundreds of millions, even billions of dollars of fines or compliance issues and that type of thing. So if that kind of reporting is necessary, it's required by the law, you better do it, because if you don't do it, even if you don't get a big fine, you may be put on a kind of a watch list, and you're not going to be able to open a new branch, go into a new territory, do some things that you might otherwise like to do because you're being regulated by the federal government in that regard.
But it sounds like you still see a pickup in activity because there's a lot going on in the marketplace. In other words, there's the entrepreneurs, there's the small businesses, there are the medium-sized companies that are still looking to invest and expand, and consequently they need funding. And so they
I'd make that as a generalization, but plenty of spottiness in terms of, you could say that, the unemployment rate is low. That's a great strong indicator of a growing, strong economy. On the other hand, who knows how many underemployed there still are.
Right.
Corporate executives that got laid off in these massive retrenchments of a few years ago and all, that have never really gotten back to their levels of before.
Right.
So still, it's not 100%.
Right. Well, that makes sense. How about interest rates? How do interest rates impact the lending climate?
Sure. Well, from a bank's perspective, higher interest rates mean they make more money. The bank's money that it lends out is composed of two aspects. One is its initial capital, which is a combination of the value of the capital stock people paid cash to buy stock in the company initially, and the earnings the bank has made over the years. That's its capital. So if it has maybe $100 million in capital, and if it's lending money at 4%, it's going to make what, $400,000. Okay. If interest rates $4 million, excuse me, $4 million. If interest rates are another 2 points, it's going to make 50% more on that same capital.
Right.
However, most of the bank's money comes from deposits. You may open a checking account, you have a savings account or CDs or whatever. The bank is generally paying an interest rate on that money. Certainly it incurs an expense to run the money, to have the money, do something with the money. So it works on a spread. So whether interest rates are 4% or they're 9%, the bank's going to work on a spread of perhaps 3.5 points. Interest rate of 3 to 3.5 points. So that's going to remain steady, no matter what their interest rates are. With one big exception, like most things, moderation. If interest rates go to 12, 13, 15%, we're all in trouble. Banks are in trouble because its borrowers aren't going to be able to pay the money back. The interest rate is so high.
Right.
So moderation.
And when you say moderation with increase in interest rates, in other words, we don't want to see 12%.
No, not again.
Within 12 months.
Or even in 10 years, frankly.
Right. Yeah.
So if interest rates now are, the borrowing is maybe 3 or 4% for a typical business. If it went up a few points to 7 or 8%, that's in several generations, that's kind of an average or a typical type of environment.
But if the bank is making profits off of their deposits, and of course they have to pay their depositors an interest rate for keeping the money with them. So let's call that number 2%, just to pick a number out of thin air. And then that spread that you alluded to, the bank then has to turn around and earn something 2+ in order to generate a profit on that book of business or that that amount of money. And so they're either lending it out to a lender or to a borrower at a rate higher than that, or they're investing the money in a manner that allows them to generate a higher profit. I mean, I know that's in a very
lending generally gets a higher return. Typically, for lending to a business, they're going to get a spread of roughly 3.5 points. If it's to consumers, it might be more than that. More than that, certainly, other than residential mortgages.
Okay.
And you said 2%? And the reality has been for the last several years, no more than 1%, which is really kind of crazy, but that's the way it is. So if we get to a point where the cost of money to a bank might be 3 or 4 points percent, your cost of borrowing money might be in the 6 to 7 to 8% range.
Right.
That's more what's been happening the last 30, 40, 50 years.
Right. So those are rates that will most likely return to, but hopefully in a more gradual
We would think, but we didn't think that this low interest rate environment would last so long. So it's going to be something. But a little bit of inflation is occurring. The Federal Reserve has been watching that. That's why they edge up interest rates a little bit. So a little bit of inflation is good, not too much. So we've got to ratchet up the interest rate a little bit to keep from growing too quickly. But growth is good. Moderate growth is great.
Right. Well, let's shift. Thank you. Let's shift to our question, and that actually ties a little bit into this discussion. Gail Young of Philadelphia writes in, how will interest rate increases affect the stock market? Right.
Well, you're the stock market investor. Perhaps you should address that first.
Well, so my take on that is that interest rates don't have a direct correlation to returns in the stock market. They're they're almost opposite ends of the spectrum, but they're connected in the middle in a manner that you alluded to. In terms of overall general business climate. And let's take the banks or financials that depend on interest rates in order to generate a profit. The more profitable they are, would then suggest investors would be interested in investing in financially related companies, and if they're publicly traded, then their stock price will go up. I'll keep it real simple and touch on what you said, and that is, a rise in interest rates in moderation normally translates into a growing economy. and that's overall good for not only financials but other sectors in the economy. Anything that increases too rapidly, though, can choke off, can have a risk of choking off that growth, and inflation could get out of control, and then we're into no man's land, so to speak.
Right, right. Well, there certainly are certain aspects of the markets and the industries that are affected more by interest rates. Certainly companies that are highly leveraged that depend more upon debt, for example. I might even point out to the private equity markets. These private equity groups, buy companies and that type of thing, and they take on a large amount of debt. Recently, there have been some very famous brand names that have either filed bankruptcy or about to go out of business and all because of the amount of debt that's been put on them by some private equity groups as investments.
Right.
So if you put on hundreds of millions of dollars of debt on any company, the company may be very, very profitable, but all that money is going to pay interest.
Right.
It doesn't have any money to open a new store or to hire new employees or to buy more inventory or something like that, so they can choke a company.
There you go.
So if interest rates are going to increase, that type of leverage becomes more deadly. So you should watch out how a company is structured capital-wise. If it's a very high amount of debt, especially if that debt's going to be variable, or the debt has to renew, perhaps. It's a fixed rate, but it matures next year. It's been paying 3% interest. Maybe it's going to have to pay 9% interest in a year or so.
Renews.
So you've got to look deeply into the financials. Trust your trusted advisors.
Right. Right. Good. Thank you. And certainly we hope that helps to answer your question, Gail. If for the rest of you who have a question that you'd like to send in, please do so.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Our guest tonight is Lisa Lemire of Kamini Bay Asset Management. Welcome, Lisa.
Thank you, Jim.
Good to have you.
Good to be here.
Well, we're very eager to hear about your new venture and what you've been doing for the past several years. But before we get there, let's go back in time briefly and talk about your background. So give us just a thumbnail of your background and consequently what has led you ultimately to where you are today.
Sure. So for about 20 years, I was in corporate America doing corporate strategy for big food and beverage companies. Left business school, went to Green Mountain Coffee Roasters.
I've heard of them.
Yeah. Then Ocean Spray Cranberries, then PepsiCo, then Aramark was my last corporate role. And, in a corporate environment, you have the chance to learn from best practice, best-in-class models, people who are unbelievably competent, intelligent. It's a fun environment to be in, and a great place to learn, I think, early in your career. A really, really great way to learn a lot of skills that now, as I've moved on and become an entrepreneur and left corporate America, have stood me in good stead.
So when did you leave corporate America then?
The end of 2010. Aramark was my last corporate role.
Okay.
And when I left, I was pretty certain I did not want to go back into corporate America. So
interesting.
20 years was enough, and my husband and I had two young boys who, one was just about to become a teen, and it was a perfect time for me to stop and kind of decompress, take a deep breath and think about what I wanted to do next.
Mm-hmm.
And we were fortunate that I could do that.
What was the connection between your corporate background and becoming an entrepreneur? That is, certain things were helpful from that previous experience, others you wanted to get away from?
Yeah, good question. So it's not as if I had ever really envisioned myself as an entrepreneur. My personality, I think, was much more suited to being in a corporate role. The willingness to deal with the hierarchy that is in any large organization, a lot of consensus building, selling in.
Politics.
Yes, politics. Yep, all the organizational dynamics. But also, I think, the structure was, for me, very comfortable. The kind of starts with corporate strategy and then flows down through the organization. So you understand pretty clearly what you're supposed to be working on. Goals and objectives are connected through the organization. You have, regular conversations about meeting objectives and metrics. And so for me, that environment for many years, I really enjoyed it, really, really enjoyed it. But I would say, to your point about perhaps getting away from some things after 20 years of that environment, I was tiring of having to deal with, I think, a lot of the same things that earlier in my career were kind of interesting. The organizational dynamics in companies, especially, I was in 4 companies, about 5 years each company-ish. So, I appear to be able to, hang in there for about 5 years before it feels like it's time to move on to a new company, new challenge, new set of dynamics. And by the end of the 4th company and dealing with dynamics, I was really ready to not do that again.
But what was that like when you all of a sudden removed that structure, as you put it?
Great question.
And now you're doing something completely different.
Yep. Yeah, I would say that it was very disconcerting, and you don't go 1 minute from being picturing yourself as a corporate executive to the next minute feeling like you're something different. There is an evolution that has to take place. First, I had to figure out what I wanted to do next, which wasn't apparent to me. And then I had to start picturing myself as that person in that role. And so there's a lot of self-talk that goes on during that process as you start to slowly let go of what you had before. For instance, it took me 3 years to fully unsubscribe from all my beverage industry magazines.
Ouch.
Yeah, it did.
I would get.
I'm off the drugs now.
Otherwise, I would have a counselor I could recommend to you.
Drugs. Yep. Yeah, and so it's not an immediate transition, I don't think, and you have to start building different daily activities and routines for yourself, accountabilities to yourself, that before you'd go into an office and they'd be there, they were very apparent. And now you were responsible for your own objectives, meeting those objectives, changing those objectives.
Now, how did you choose your entrepreneurial venture? Most people, when they start a business, because they've been in that business for a period of time,
Right.
They repaired cars for somebody, and now they're going to have their own shop, for example. How did you make that decision? What's its relationship to what you're doing now, from corporate to what you're doing now?
Great question.
If any.
There really wasn't a lot of connection to the knowledge that I had before, the industry knowledge that I had before. So I was deep into beverage strategy, understood hot, cold beverages, consumers, how we drink, what we drink, blah, 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 all of that stuff. And when I left, what drove me to where I am now was really one link, and it was the quest for passive income. So when you go to a job, every day, if you stop going to the job, the income stops coming. Sure. And that's true if you're a small business owner yourself, if you own your own gig, but you still have to go every day. My husband and I own some rental properties, and so we have some passive income that comes in from them. And it was the quest to get more passive income. So we actually had to work less, meaning have less kind of daily jobs that was the link to what I'm doing now. So while my husband buys bricks and mortar properties, I buy mortgages. So not the properties, but just the paper, the mortgages. And the mortgages are an asset that cash flow. And so there's passive income that comes from them. So that was the link, which is why it seems so disparate to go from corporate strategy
First
to
blush, sure.
basically running an investment fund.
So complete that description, if you could, Lisa, for our listeners. So you're in a business where you buy mortgages,
Right.
and you're also, your husband is on the real estate side. So your structure today looks like what, and do you have outside investors, and where do they come from?
Yeah, so I do have an investment fund, formally put together a private placement memorandum and have investors, and the investors are pooled, so I manage investor capital. And that was actually one of the more challenging pieces for me coming out of corporate America, was the starting to figure out how to talk to people about investing in my fund and basically in me, in trusting me. That took quite a while to figure out how to have that conversation with people. So I now have a fund and I have investors, and I owe the investors a return. So, they've entrusted their money to me that they earned, took them a while to earn. And so I pay them a return for using their money. So that my kind of business cycle is I look for banks and mortgage companies that are selling their mortgages and negotiate pricing with them. Then I don't talk to the borrowers specifically, but I have folks who will talk to the borrowers, and the borrowers are not paying their mortgages. The mortgages I buy are distressed, so they're not paying the mortgages. And I do not ever want their house, want to work out a payment solution with them, modify their loan terms essentially so they can pay their mortgage, and so they can pay their mortgage ongoing for the term of the loan without us having to talk again. So that's the middle piece, and then from those payments I pay investors a return.
So
That's
you're
the cycle.
well-educated, loads of great experience and that type of thing. Became an entrepreneur. Do you have any, I hear you did a lot of planning and that type of thing. Were there any real surprises that sort of like, whoa, I never thought this was going to happen?
Yeah.
Our viewers would love to
Yeah,
hear
good
some of
question.
that good learning experience
Yeah.
for all of us.
Yeah, I think there have been a few of them for me. One was kind of the vacuum of suddenly being accountable to myself, and not having a structure that I was accountable to so much. So, I don't really have a boss so much. I feel certainly a fiduciary responsibility to my investors, but that's a pretty loose structure compared to stepping into a corporate environment every day. And so it was a little challenging for me, not so hard to put the goals together. That part was easy. It was more the daily routine. It's the habit of, every day doing the things that you need to be doing to hit those goals without the accountability built in around you. And so that takes some time. For instance, when I started, a friend and I would talk at the end of the day at 5 o'clock, 5 minutes. Not judgmental, we'd check in with each other. We each had businesses. How did you do against your daily goals? And that was really helpful because at like 4:45, if I hadn't freaking finished, I was like doing whatever I had to do so I could get on the phone with her at 5 o'clock and say, I did it. So that was helpful. The other thing that's been interesting is that as I've been talking to people about investing, I've come to realize that we as Americans are not particularly financially literate.
What do you mean by that?
I mean that most people are fairly unaware of what's happening with their savings and how to evaluate where they want their savings to be and what vehicles they would like to place their savings in.
Here's an interesting question. Do you have a sense as to why that's the case based on your experience? Why there seems to be a void of that understanding?
And do you have that understanding, or did you have that understanding before you got into this?
Yeah, it's a great question. So I think I think more understanding than most people have, partly because I have an MBA. And so when you go through that kind of environment, you learn more about money, finance, what you're doing, where money can go. But what I would say, and I think this relates to your question, Jim, about why I think it is, I don't think that our families, it doesn't come down through our families, the conversation about how money is made, how money flows in our economy, and what the options are for what we do with that money. So I don't know about you guys, but that was not a conversation in my household, not at the dinner table, not, budgeting maybe, but the different opportunities to get different return on my money, and where, handing it to a financial planner versus...
I think some families think that's too personal. I'm the dad or I'm the mom, and I'm not going to discuss all our family finances with the youngsters or something like that.
Right.
There's got to be another way of doing it or something to maybe avoid that, but to at least get them involved in what the family's going through. I mean, certain people who went through the Depression, they got a pretty good lesson on how it works.
That's right.
I'm sure you see it a lot with
all
your...
the time. All the time. Yeah. We're winding down here, but I do have one question that I want to finish up with if we can, but I need a relatively quick answer.
Sure.
What keeps you up at night, if anything, from a business standpoint?
Yeah, I think really it is a little unnerving to have responsibility for other people's money. It was easier when it was just my husband's and my money that I was investing. We're pretty, on this aligned, but that's really it. The kind of the fiduciary responsibility and feeling like, people have trusted me with their money.
Yeah. And there are other things they could have invested in, whether it's a stock market or somebody else's fund or something else. There's a lot of alternatives out there, even this virtual currency now, things like that. So.
Right. Well, and then I'll just add a comment, and that is, in my opinion, financial journalism and the media does not do most people any favors in providing the appropriate insight and understanding, kind of going back to what you said, Lisa, in terms of truly giving an education at a level that allows them to make a decision. It's almost as if the information that is fed to us through the various media sources is they've made the decision and here it is, as if there's a prediction in there, which of course nobody can do. But it's presented that way and has been really ever since I've been in business. So
interesting.
Yeah. Well, thank you.
Thank you.
We could keep going, obviously, but maybe we'll have you back at some point.
Chapter 4.
There you go. And thank you for tuning in to Money Matters. Our guest next time will be Philip Williams, who's the CEO of Game Face Grooming, which is a new company. I think I'll join you and tune into that to see what exactly Game Face Grooming is. In the meantime, thank you for listening to Money Matters.